Top financial mistakes that sink startups. I'm your co-host, Waseem Daher, CEO of Pilot, and I have with me
Immad from Mercury.
Thank you all for taking the time. So just to step through our agenda, we're going to cover four big buckets of things. The first is finance mistakes startups make and how to avoid them. The second is discussing setting up budgets and revenues. The third is a question we get a fair bit, which is, what do I need to do now? Do I need a CFO? What are the most important things I need to set up from day one? And the fourth is we want to keep it really interactive with Q&A with you, the audience. So to begin, first intros, I'm Waseem Daher. I'm Pilot's CEO. This is actually the third startup for me and my co-founders. We had two companies before this. One that was called K-Splice that did software updates without rebooting that Oracle acquired. And the second was called Zulip. It was a group chat tool for businesses along the lines of something like Slack that Dropbox acquired. And the motivation for us for starting Pilot was really pain we had in our previous companies, pain around the bookkeeping and the tax prep. We wanted to be laser focused on growing our business. And instead, we found ourselves struggling with figuring out how to get this stuff done. That was really the motivation for starting Pilot. And Pilot, in brief, is a full service bookkeeping and tax prep company focused specifically on startups. When you work with us, you're paired with your dedicated account manager, who's a full-time employee of ours, who's here in our San Francisco or Nashville office, who does the books in QuickBooks using all the industry standard tools. And then under the hood, we have a team of engineers that is building software tools that let us do the work super reliably, super consistently, super accurately. And I'm really, really happy to have with me as my co-host on this webinar, Immad. So Immad, I would love a quick intro from you.
Hey, how's it going? I'm the CEO and co-founder of Mercury. We're building a bank for startups. This is actually my fourth company. I won't bore you with my previous ones, but I also have invested in like 120 companies. So I'm going to be kind of helping talk about kind of projections, revenue projections, budgeting. Part of the reason I started Mercury is I was found that kind of the banks we used at our previous startups were always limited in terms of how much they kind of helped you understand your finances, understood like these weird costs that sometimes get incurred, and you just wouldn't always be on top of them. So that's one of the things we wanted to solve at Mercury. I wanted to kind of use this webinar to talk about some of those things that can happen to startups that can like surprise you and like how to prepare for them.
And so for both of us, this is really, both of these companies are kind of both of our experiences over the course of many startups is born out of pain we ourselves very, very viscerally felt. So I think we'll have a lot of good content for you today. And then if there's stuff you'd like to ask in the Q&A, I think you have a great opportunity to be able to pick Immad's brain. He's obviously a deep expert on this, both in the companies he's done himself and, as he mentioned, in his many angel investments. So without further ado, I wanted to talk about avoiding basic finance mistakes. And so we talk to startups all the time in the course of operating our own business, and we wanted to produce kind of the hit list of here are the things you should definitely try to avoid and why, or here's some of the best practices that you should be keeping in mind. So the first, and I think if there's only one takeaway from this entire webinar, it's this. It's don't mix your company's money and your own personal money. This is a thing that's called commingling. And when you do it, it's really, really bad. And it's really bad for a couple of key reasons. One is you actually don't have good visibility or insight into the health of your business because you haven't been cleanly tracking what money the business is making, what money the business is spending. But the second is the government also really, really doesn't like it. And the government really doesn't like it because their view is going to be, if you have a company and the company is paying for something that is your personal thing that isn't a legitimate business expense, the IRS will say, oh, hey, actually, what you're doing here is you're actually using this as a way of paying yourself, but you're not paying any of the taxes associated with it. So they really, really don't like this. So both from a compliance perspective and from a hygiene perspective, if there's one takeaway, it's this, which is as soon as you have a company, get a business bank account for it. And obviously we love Mercury for this, but get a business bank account immediately and keep the company's funds separate from your own personal funds. If you personally want to buy something, do it with your own personal money. If the company needs to buy something, have it buy it with the company's money, either on the company's debit card or credit card or a check or whatever you'd like to do. But clean separation of the company and your personal finances, I think, is the absolutely critical step one. The second, which is somewhat related, is hopefully you're now in a position where you've raised a little money or you've made a little money and you want to bring on some employees. The thing we strongly recommend here for employees is always using a payroll system to pay those employees. And this is, very, very simple to set up. These services are not very expensive at all. Gusto is one we really like. I think it's something like $30, $35 a month to get started. The reason to use one of these payroll systems is there are a bunch of complex requirements around paying people. In particular, the employer has to withhold some of the salary for taxes, and then the employer has to pay some of that to the government on a quarterly basis. There's a bunch of sort of complicated rules around tracking this all correctly. It's not as simple, unfortunately. You can't just write a check to someone and say, oh, I've paid you if they're an employee. If they're an employee, you have to basically follow all of these complicated rules around verifying their employment eligibility and tax, et cetera, et cetera. And these systems will take care of all of this for you. And I think the theory on a lot of this stuff in this presentation is really kind of about an ounce of prevention being worth a pound of cure. If you set up some of this stuff very, very early, you'll be so happy that you did later because you won't have to fight retroactively to figure out how to fix this stuff up after the fact. So we see this a lot where people just say, oh, I'm going to hire an employee to do a thing. Let me just write them a check. Like, please don't do that. Please set up a payroll system. It will make your life much easier. The third, and this is a little bit of a counterintuitive one, which is for most startups don't make money. They lose money. And because they lose money, they generally don't owe taxes. However, even if your company didn't make any money, it still has to file a corporate tax return. Even though what that tax return is probably going to say is, well, look, we didn't make any money and therefore we don't owe any tax. That doesn't reduce your obligation. Like, you still have to file the return. And this is generally at the federal level and the state level. So we strongly recommend leaning on a tax preparer. And of course, we do tax prep, but any tax preparer will be able to help you with this stuff. Your company still has to file a corporate tax return if it has existed at all in that year, even if it didn't do anything, even if it didn't make any money. And the second one that's kind of related here is that corporate income tax isn't your only obligation. So the corporate income tax, I think, is one that most people sort of know or kind of have an intuitive feel for. Oh, yes, this is something that a company needs to do. It needs to pay taxes. But there are a series of other obligations that you may have. So for example, if you're incorporated in Delaware, there's a Delaware annual report and a Delaware franchise tax. Then there's generally, there are associated state and local filings. Like in San Francisco, for example, there's a San Francisco gross receipts and payroll tax. There are kind of a handful of these kind of other miscellaneous tax and kind of compliance obligations that you need to meet. So it's important to know that, hey, that's actually something I should be paying attention to. The fifth one of these is really just to make sure someone's watching the books. And specifically, the reason I say this is your main job as the founder or the CEO is really to do two things. One is it's, of course, to advance the mission of the business, to achieve the thing you set out to do in the first place. And the second is to make sure that your company doesn't run out of money. And so one of the key steps of making sure your company doesn't run out of money is making sure that someone is doing the bookkeeping. And Immad's going to talk a fair bit about kind of budgeting and forecasting in a bit, but having someone who is taking care of this is important, whether it's someone in-house or whether it's an external firm. The way I would approach this question basically is thinking about comparative advantage. If you can work with someone who is a deep expert on this, all the better, but just make sure someone is keeping an eye on it. And so I wanted to dig into this a little bit with a topic about cash versus accrual bookkeeping, because when I say make sure someone's keeping the books, what also matters is how they're keeping the books. And there are two methods that you can use to track for bookkeeping for companies. One is called the cash basis method, and the second is called the accrual basis method. And what is the cash basis method? The cash basis method is a system for tracking money when it is spent or when it was received. And this is probably like how you operate in your personal life. If someone came to me and said, hey, Waseem, how much money do you have? I would like open up my wallet and be like, well, there are $7 in here. I have $7. I consider money earned when I receive it, and I consider money spent when I actually spend the money. But what's interesting about the cash basis method is it doesn't really fully capture the complexity of a business in the way that you might like. And I have an example here where in the top right of this screen, I have this kind of box that says sales. let's say I sell a device and it costs $100. And in March, I sell one of these to Immad, but he doesn't pay me until April. And then in April, I sell another one to my friend Joe, and he pays me promptly. The way that I would record this in the books, if I was using the cash basis method, is I would say, well, sales in March was $0 because I didn't collect any money in March, and sales in April were $200. And the problem with that is that's a little bit misleading, because when I look at that to assess the health of my business, I might say, March was a really, really bad month, but April, we did great. Whereas in fact, the reality of it is, no, I did just as well in March as I did in April. I didn't happen to receive the cash in March. And so that's where the accrual basis method comes in. And the idea of the accrual basis method is tracking money when it is billed or when it was earned. So in March, when Immad bought the device from me for $100, I earned that $100 even though I hadn't yet received it. So that shows up as $100 that I've made in sales in March. And then similarly in April, when I sell the other device to Joe, that's $100 that are made in April. So you actually have the choice with your company about whether you'd like to use the cash basis method or the accrual basis method. Both are valid, but our advice is that the accrual basis method is definitely the way to go for technology startups. As you grow, your investors will insist on it. It captures some of this complexity really well. As we'll see in another slide, it's important for a variety of reasons. But on the topic of cash versus accrual, we think accrual is really, really critical. And the second idea here is this idea of revenue recognition. And this is most relevant if you have a subscription service of some kind or if people prepay for your thing. And the idea of revenue recognition is it's an extension of the principles of accrual basis, which is just because you collected the cash doesn't mean you earned it. So for example, if I'm in the business of selling a subscription that costs $100 a month and I sell annual plans, if I sell an annual plan in January and I collect $1,200 in January, I shouldn't think about that as $1,200 of revenue in January. I should think of it as $100 in January, $100 in February, $100 in March, $100 in April, and so on and so forth. And the remaining money that I've collected is not revenue to the business. It sits on my balance sheet in a category called unearned revenue. Over time, as I perform the service, I earn the right to actually recognize that revenue. So this is the idea of revenue recognition, and it's only possible if you're doing the bookkeeping on an accrual basis. And as the business kind of grows and matures, that becomes increasingly important. Now I'm going to turn it over to Immad to talk about projections and budgeting.
Thanks, Waseem. Yeah, I think projections and budgeting are like very important, and it's not something that kind of like anyone really teaches you as an entrepreneur. It's also like tempting to think that one can outsource it, but A, like you understand your business better than anyone else, and B, it's just not that tricky. I tend to start from like projections first and then do budgeting afterwards. There's a little bit of like a contradiction with kind of every entrepreneur where you want your projections to be like very optimistic, but you need to do a budget in like a very conservative way, just because, you know, projections is something kind of aspirational where you're aiming for, but budgeting is something where like you really don't want to run out of money and you don't want to have like unexpected costs hit you and like you don't have any buffer. So it's important to kind of do both of these and also kind of track them against reality afterwards. So talking about revenue projections, I think it's tempting to just kind of make it up and say, oh, I'm going to make like 10K this month and then 20K the next month. Yeah, the reality is like, that's not believable and it's not going to be like work out that way. If you think about it like that, so really bottoms up model is the right way to do it. Ideally, you have some like historical levels where you're like, okay, this is how many customers I had last month. This is the revenue I make per customer. This is how we're growing. And we can map that out into the future. But even if you don't have a historical basis, it's actually like a healthy exercise to understand like how much you're going to make per customer. You know, what are your acquisition channels? Is it like a sales process? And if it's a sales process, like, you know, how many people are you going to reach out to? How many people are you going to close? And that's going to determine like your customer number. I think I would normally go take the projections for like probably 3 years, maybe 2 years out. I know it goes like more and more crazy into the future, but it's still a healthy exercise. It can also it helps you determine other parts that are not obvious. It's like, okay, actually you do need to hire more salespeople if you're going to hit these numbers, and hiring salespeople takes several months. So like being prepared for what you need to be hitting helps you with that. It also helps you understand, especially if you do it like before you raise, let's say, a seed round, it helps you understand what are the metrics you need to hit before you hit a Series A. I would say, yeah, even if investors don't ask for it, there's kind of an expectation that you have a good kind of model for how your future growth is going to be. So it's healthy, and it's good to just do it up front. And it's not, I wouldn't say it's like make it like crazy and complicated with like thousands of rows. It's mostly, but every column is like a month, put a number for customers, put a number for growth rate, put a number for revenue per customer, and that's your projection. And then, if things are going to change, like your growth rate is likely to fall as you get bigger, and that's, very common, do that, and try to match it to like what you think is realistic and achievable. But obviously it's a revenue projection, and as an entrepreneur, you should be optimistic. So most of the time you're not going to hit them, and that's kind of expected. Some of the times you will hit them and maybe beat them, and that'll be great. So that's one side of it. As I was saying, like you kind of have to do a reality check. Is it likely that in the first kind of couple of months you'll suddenly have 10,000 customers from like zero? No, it's not. So you have to think about like, what is your distribution channel? Where are these people going to come from? And if they're coming from like X distribution channel, like how does that compare to like the projections that you have? And then another part of the reality check is like, does this growth get you to your metrics for your next fundraise? And if it doesn't, like, sometimes like I talk to an entrepreneur and like the reality is that the business model just doesn't work very well. Like they're not charging enough money, or there's other issues with it, and it's just not going to be realistic to like grow fast enough to kind of get to the next fundraise, which, the next fundraise isn't everything, but like in the kind of startup life, especially if you're burning more money than you're making, you kind of have to be prepared for like what are the objectives you need to be hitting. So after the kind of those projections are done, you have to think about a budget. So again, we're not talking about thousands of rows, but I do think it's important to make it like relatively detailed. The biggest cost for most companies, especially startups, is people. I would break it down and say, okay, this is how many engineers I have, this is how many designers I have, this is how many salespeople, whatever else. Break down kind of that top level headcount and do estimates on like what are the salaries that you're going to be paying out for that. Split out some of these high level costs associated to people. So health insurance is a big one. If you're doing a 401k match, which is like a 4% extra kind of on top of the salary, that can be quite expensive. So break out some of these top level things. And then on top of that, so everything I do with the budget tends to be like very like worst case scenario, throw in lots of extra costs just in case, right? So on top of all the people costs, I'll normally throw in like an extra 10% cost because you just don't know where that's going to come from. And then additionally, break down the office cost, break down the AWS cost, whatever is like your kind of top drivers, and then also throw in like kind of a miscellaneous like 10% cost at the end. You really want your budget you really want like every month to be ahead of your budget. Like you want your costs to be like, you want to be surprised by like, oh, I spent 10K less. This is great. I can go get myself some champagne or something. You don't want to look at your budget and go, oh, wow, like I spent too much money and I'm going to run out of it. So that's kind of the mentality to take. And one thing that's like kind of a contradiction to the revenue projections is in your budget, you just like, I normally do it like almost assuming no revenue growth. If you have like been running the business for a while, you can kind of predict some level of like revenue growth. But I think it's fairly healthy to be extremely conservative with revenue and expect it not to grow very much. And on the cost side, just expect the cost to be like more expensive than you think they'll be. And then hopefully at the end of it, you'll feel pretty good. And then the other thing to do with the budget is not just budget out like what you're going to be doing today, like budget out, okay, I'm going to be hiring 2 people in 2 months time. This is how much that's going to cost. And that really helps you understand yeah, not just like your runway based on like your current costs, but your runway based on like what your projected costs are going to be. Again, it's not super crazy. I think you could get it done in like an afternoon. One thing that I found useful in the past is also kind of talking to some other entrepreneurs, especially if they're selling a similar type of business to you. Like if it's SaaS, then talk to SaaS entrepreneurs. If it's e-commerce, talk to them. Ask them like what are their costs. Things like sales, taxes, VATs. There's a lot of other costs that are like kind of specific to the type of business you're in that may not be obvious, especially right at the start to you. So it's good to have like a handle on like all the different kind of rows that could be like impactful to your budget. Yeah, so at the end of it, the simplified thing that you should be reporting kind of in your investor updates is the burn rate and runway. So burn rate on a simple level, last month minus this month is how much money you're spending. It should take into account like revenue within that month as well as your costs. And then if you take kind of cash in bank divided by runway, that's how long you'll last. I think like, I wouldn't really get anywhere close to like a 3-month runway without having like some serious plans on like what you're going to do, whether it's cut your costs, grow your revenue, or like go fundraise. I think it's healthy to actually be 6 months clear from that because you just don't know when an unexpected cost will come up, or like whether fundraising or revenue growth is going to be quite as good as you think it's going to be. So it's always good to have like a very healthy runway, and like also in the back of your mind be thinking about like if I need to cut costs very quickly or need to like grow revenue quickly, like how am I going to kind of do that? It's always nicer to just be making more money and not worrying about this stuff. As in my 13 years of startup land, I've many times been very close to running out of money and kind of scrape by at the last minute. So nowadays I tend to be like extremely conservative about these things. But yeah, as I was saying in the previous slide, it's there's the runway based on your current burn rate, but you really have to also think like, if I'm going to hire another 3 people, what's my runway going to be like in 2 months time? So it's not just about like your current burn rate, although it's helpful to and healthy to understand that. It's also like kind of projecting it out a little bit. But I think it's all actually like very doable by any kind of entrepreneur. It doesn't need like this is a point that Waseem's going to talk about in a second, but I don't think this needs like a CFO or a financial person. I think at times it can feel intimidating, but I think you just get in kind of a Google spreadsheet or Excel and just start writing rows out, and you kind of understand your business better than other people. So and I'm happy to kind of help in this Q&A or like afterwards if someone's like kind of wants to have like a template or something on how to do budgeting and runways and stuff like that. All right, back to the scene.
Thanks, Immad. And I definitely agree on that, which is especially for something like burn rate and runway, it's really important that you, the business owner, understand the metrics of your business. And I think the nice thing about burn rate and runway is it's a super simple, super clean, very easy to calculate one. And I strongly recommend actually that any business owner knows. Like if you ask me off the top of my head right now, if you were like, Waseem, what's Pilot's burn rate and what's Pilot's runway? I could tell you those numbers. I'm not going to, but I could. And I think that's an important thing to think about, which is ultimately, I think the success or failure, like this cash position is the lifeblood of the business. And I think it's very challenging for your plan to be to lean on someone else to figure that out. I think you are ultimately accountable for this. And therefore, I think it's important that you have a good handle on how this stuff is working. So I want to shift gears a little bit and actually talk about another kind of tip or recommendation we have is really getting set up on a solid financial stack. And the thinking on this one is it's somewhat of a paradox in the sense that realistically, the success or failure of your company is not going to be determined by how good your bookkeeping is. No, like the success or failure of your company is going to be determined by whether you built something that people wanted, whether you have compelling product market fit, et cetera, et cetera. But there's a lot of stuff where just, again, getting it set up right on day one will save you a lot of pain, will save you a lot of time down the road. And so what we wanted to present here is Pilot's recommended financial stack. So we kind of have the main categories here: a bank, credit card, payroll, expense reporting, credit card processing, accounting software, and then AP and AR. Bank, obviously, we're big fans of Mercury. There are a handful of banks out there that cater to startups, but Mercury's focus area specifically is tech startups. And our experience has been, if you find a provider that has that deep specialty, why not take advantage of it? Because they'll know you, they'll know your customer base very well. Corporate credit card, we think Brex is a good option. We think there are lots of other good ones out there. Payroll, we really like Gusto. Expense reporting, we're big fans of Expensify. The idea on expense reporting is, if you or your employees, if one of you buys something on behalf of the company and needs to be reimbursed, we strongly recommend using a system like Expensify to track that. And it may seem like overkill. It's just like, well, can't I just like add a little bit to their payroll, or can't I just write them a check? Like, you could, but Expensify is also very cheap. And then you'll know exactly, well, was there a receipt? Did someone approve it? It's actually about getting in place process that will scale well as the business grows. Credit card processing, we really like Stripe. Accounting software, we're big fans of QuickBooks Online. It's definitely the industry standard on this stuff. And then if you have significant volumes of bills or invoices that you're sending out, we like Bill.com. There's another one called Routable, actually, that we really like as well. And then, of course, we're biased, but for a bookkeeper and tax preparer, obviously, I'm a big fan of Pilot. And I want to shift gears here, actually, and talk about one other bonus topic, which is, if you're a tech startup and you're paying a fair bit of payroll to engineers, basically, you potentially have the ability to claim this thing called the R&D tax credit. And normally tax credits are not of particular interest to startups because, as we sort of mentioned, generally tax credits offset tax you owe the government. And most startups don't owe the government any tax because they don't make money. But the R&D tax credit is a very, very interesting one because it offsets your payroll tax. And you owe payroll tax if you're paying anyone, regardless of whether the company is making money or not. So this is something you can talk with your tax preparer about, whether it's Pilot or someone else. There's a thing you can do called an R&D tax credit study, which basically, some report is produced that says our company has spent this much on R&D, and then you're able to deduct some of that from your payroll taxes. And we have companies that we work with that have saved literally hundreds of thousands of dollars by claiming this R&D tax credit. So definitely worth looking into. And the final thing I wanted to talk about with this group was, this is sort of a question of who does what, and this just touches a lot on kind of what Immad said as well. One question we often get is, do I need a CFO? And my answer is actually, if you're not positive that the answer is yes, the answer is no, that you don't. And why do I feel that way? Well, let's break it down into the 4 or 5 different things that a business needs to do, and then my recommendation for who should do them. So the first is corporate income tax returns. We talked about this a fair bit. Regardless of whether the company is making money or not, you have to file these tax returns. Strongly recommend hiring a tax preparer to do that, whether it's Pilot Tax or someone else. The second bucket is these non-income tax regulatory filings, et cetera, et cetera. For this, I strongly recommend, again, just leaning on the tax preparer. This is things like the Delaware franchise tax, the San Francisco payroll tax, help with the 1099s process, et cetera. The third is month-end bookkeeping, which is really keeping track of how money has moved into and out of the business. For this one, I recommend you hire a firm that specializes in bookkeeping, ideally bookkeeping in your industry. And then the fourth is day-to-day items. So for example, hitting run on the payroll system, writing your rent check, computing someone's sales commission or whatever it ends up being. On the day-to-day items, what we've found is a lot of this requires some very, very intimate knowledge of the business. And in the time it would take you to write the email to the external firm to say, hey, can you pay this person? You could have just done it. And it will save you just time and money to knock this stuff out. And then the fifth bucket here is the kind of budgeting, forecasting, projection stuff that Immad talked about. And I think it's tempting to try to outsource that stuff because you're like, well, I don't know about this. I might need some help doing it. I think it's totally fine to get help from someone to do it. But I think ultimately kind of you, the business owner, have to be accountable to it. You have to know about the health of your business or the status of your business. And so actually, if you look at kind of these buckets that I described here, none of them are, oh, I should hire a CFO, which is a good thing because actually CFOs are also incredibly, incredibly expensive. So it's nice to be able to save some money by not kind of making that higher. That's the set of prepared content we had for you. We want to now turn it over to Q&A. So we're going to quickly pull up the questions that folks are asking here on the webinar, and then we'll talk through them. So let's see what we got. If you have questions, you can click the Q&A button on the webinar panel, and then I think we should be able to see them. Well, while we wait for some questions, we had one that was submitted by email previously. Someone had asked, how should I think about where to incorporate, or does the state that I incorporate matter? I was curious, Amanda, whether you have thoughts on that question, or how companies should think about the sort of basic incorporation stuff.
I think in general, if you think you're going to raise money from outside investors, especially like startup investors, the standard is do a Delaware C Corp. And the reason that standard is Delaware has like a lot of kind of business rules and legal cases that like everyone likes. It's also, yeah, there's enough things that are difficult about fundraising that you don't want to have a question around, why did you set up like a Wyoming LLC for this? I think if you're thinking about this more as a bootstrap business, there is definitely like some reasons not to do a Delaware C Corp. Like the Delaware does have like a relatively expensive franchise tax. And if it's C Corp, it's not a pass-through tax entity. So it's, you know, an LLC or an S Corp as a pass-through entity, which makes it like a cheaper, and you can kind of deduct more things. So it partly depends on like what are your aspirations for the business. If you do not think this is going to be receiving outside funding for either a long time, or at least for now, I would keep it simple and just do like a local state LLC. Those are the two things. These things are fixable. You can switch companies, and you can switch even from an LLC to a C Corp. So it's not the end of the world if you choose the wrong choice here. But if you're definitely thinking, okay, in the next 6 months to 18 months, I'm going to go talk to external investors because this is like a tech startup, to start off with the Delaware C Corp. That's the obvious default answer.
I definitely agree. And then the guiding principle from my side on this is, I think there are areas you want to be creative. And one area you want to be creative is in your product and your approach to the market and the thing you're building. And I think there are many areas where you don't want to be creative. And I strongly recommend not being creative on the stuff that is not key or core to your business. So whether it's accounting or finance or legal or the location of a corporation, generally the more you look like other companies, the easier your life will be, because you won't have to contend with the sort of special edge cases that are associated with some complex structure you came up with. And to Maud's point also, if you're going to raise money, your investors will generally require that you have that Delaware C Corp shape anyway. And so they'll basically make you throw away your complicated thing to instead do the thing that they're sort of expecting. But one of the things you said, Immad, was actually an interesting segue, or kind of got me thinking about a question that we frequently get, which is, how do you think about whether companies should think about bootstrapping versus raising external capital? Or how would you sort of make that decision? How have you made that decision in your previous companies, or how would you advise folks that have been asking that question to you?
Yeah, that's a good question. I think there's kind of like two aspects to it. There's like, what is your aspiration for the company? And then it's like whether, you know, what is kind of the idea, the product, the business model, which are like kind of separate points. There's a set of companies that are like VC fundable, and even with like smaller, you know, sometimes people think, oh, it's a seed stage thing. Like, why do I need to be a VC fundable company? Most investors, especially in Silicon Valley, but really everywhere, are looking to, you know, in the seed stage, they're looking for things that do grow into like VC funded companies, because they make up for the extra risk that they're taking, because the company's outcome can be much bigger. So you really, and like actually doing that revenue projection thing that we talked about is pretty useful for this. You really need to be able to look out like in some scenario, and obviously it's a very optimistic scenario, in like 5 to 7 years time, like, does my revenue grow to like 100 million per year with like good gross margins? If you can't make that argument to yourself and convincingly to external investors, then you're probably not a VC fundable company and you should bootstrap it. The other aspect of it is like much more like aspirational, which is, what is the type of company you want to run? If you really want, I think for many situations, a kind of bootstrapped or lifestyle company or whatever is what the person wants to run. They don't want to be always thinking about growth. They want to, they have a path to like getting to profitability, and they want to run the business and, have a reason. I mean, I don't think it's necessarily that much easier, but I do think like once you get to a stable position, and I know people in this position where, you've kind of done the grind, where you've got it to profitability, you can kind of step off the gas a little bit and have the business like run. And you still have to obviously work, but it's not something that you always have to like push on. Whereas, startup land, the more successful you are, the more painful it is, really. Yeah, like, you have to keep growing. There's the expectation from VCs, and it's kind of like what you've set out to do as well. You're trying to make the biggest company possible. And when you run out of that steam, it's not a situation where you can really back off until like there's an exit, or potentially there's situations where you get like external kind of CEOs and things like that. But it's definitely like much more of a hard job. But the upside is bigger. I personally like trying to make something big and have a big impact. And it's like, I guess I've signed up for the pain. But yeah, those are my thoughts about it. I think like they are separate things, and people shouldn't like just be pressured by other people and like blog posts about like, actually nowadays there's lots of pressure to do bootstrap things. Even back in a few years ago, it used to be like all the pressure was like, oh, you don't want to do a startup. So I think like in general, like make your own decision on this stuff and don't be like influenced by like what other people are saying.
I definitely agree. I mean, from my perspective, it's really about, kind of as Immad said, what you're trying to do with the business and what you're trying to accomplish with the business. And one note that I think is a little bit counterintuitive is if the goal is wealth creation, and I don't think that should necessarily be the goal, but if it is the goal, and I'm making these numbers up, if you want to make $10 million, it's a lot easier to make $10 million by owning 100% of a business that is worth $10 million than by owning a business that is a small percentage of a company that's worth, $1 billion. Like, one of those things is just far easier to create than the other. And so I think Immad's point is exactly right, which is what is the objective of the business? Okay, so we've got a fair number of additional questions here. I'd love to kind of tear through them. So we've got one from Arrow Ainsley, who writes, what should I value my business at when I incorporate? Can a low valuation at inception, which is good for low par value in Delaware, result in a huge share price jump when I start funding? That's a good question for a lawyer, but my understanding, and Immad, I'm curious to know whether you've ever done anything different here, is when we've incorporated our companies, we've generally set the par value to be like as low as possible, like 0.001 cents or something like that. I don't know if you have any kind of hands-on experience from this question.
Yeah, I mean, in general, unless, and there are situations where you can't set it that low. Like if you've received funding already before you incorporated, if you're already making revenue and like you're kind of pulling that IP in. So there are actually situations where you can't do that. And you should, if you are in any sort of like a weirder situation, you should definitely talk to a lawyer about it. Generally for incorporation, I would either use like a lawyer that understands startups, or like use something like Clerky or Stripe Atlas that is kind of startup focused incorporation, and they will help you with some of these questions. But yeah, if it's really the start, you don't have much going into the company, you value it low, there is a price jump at funding. It doesn't matter because as a founder, at least you buy your shares upfront, even if they're vesting over time. It does matter to employees because you're going to be giving like stock options to them. And there's a process called 409A, which actually surprisingly a lot of founders don't know about that. Basically, if you ever want to give employees options, you have to value your company. And the way to do that is with a 409A valuation. And there's a few kind of tools like Fast 409A and Carter that kind of help you do those. But yeah, don't just give startup employees options without like doing a 409A and like having, working with some sort of legal tool or legal firm to do that. But yeah, that's the only point where like valuations matter particularly. But yeah, inception, like just the fact that there's a jump doesn't matter too much.
Yeah, agreed. And I would definitely recommend, kind of as Immad said, using a service like Stripe Atlas or like Clerky to incorporate. The other one that I'm aware of that is a big pitfall when incorporating, and this is a question that someone asked, which is what are some unforeseen or costs or expenses that can kill a company? There's a thing called, if you issue shares to someone, there's a thing that you need to file called an 83B election that is really, really important. For most things in the world, if you miss a deadline, you can pay a penalty or undo it. And for whatever reason, for this 83B election specifically, you cannot. You have to file it within, I think, 30 days of having the shares issued. So if you work with something like a Stripe Atlas or a Clerky, I think they generally will kind of walk you through that process. But that's definitely something to think about when you're issuing shares as part of your startup.
83B elections are specifically for shares that you're vesting. So even as a founder, you want to always vest your shares over like 4 years or 6 years or whatever is a comfortable schedule. In that situation, because you're like buying the shares up front but not receiving them until over time, 83B election allows you to like not have to pay tax as you receive them, which obviously is going to be much worse.
Yep. And then another question, and this will be a good one for you, Immad, which is, one participant writes, why should a startup open an account with Mercury versus SVB?
Since I'm going to answer that, you got to answer the next one about pilot versus bench. So SVB is kind of like this. Yes, it's Silicon Valley Bank. They're the old school kind of incumbent. They started in 1983. Everything about Mercury is like very product and customer focused. So you can sign up all online. It takes 10 minutes. We get your bank account in like a couple of days, and then there's a bunch of like really obvious things that we do that these incumbent banks can't do. Like if you want to search for transactions, we have a keyword search and it's super fast. If you want to find transactions more than 90 days old, you don't have to dig through PDFs. If you want to make a payment to an existing recipient, you don't have to go through like a 20-step kind of puzzle on the website to figure out how to do that. So we've really made a product from the ground up and made it kind of suitable for startups and just any kind of business owner to use. So that's one side of it. The other side of it is we have business tools, like we have an API, and we're building other things to really help you get more out of your bank that you just wouldn't even think is possible. But from like a modern tool you would expect. And we also try to kind of democratize these kind of financial products. So we have a savings account, which for most startups would be around 1.45%, which with most other banks you have to, if you jump through enough hoops, maybe they'll give you access to it, but most of the time you just don't have access to those kind of financial products. And we're launching new ones. But the idea is, we really want to be customer focused. We want to do great things for our customers, and we're going to keep kind of building those products for them. That's that. But we're definitely the quickest and easiest way to do it as well. So, and we're all free. SVB and many of the other banks do end up charging you kind of monthly fees and like fees for random things. We don't have any minimums. We're an online service, and one thing that I firmly believe is that banks are dealing with bits, and like bits are like pretty free. So charging fees for like overdrafts and like all of this stuff, I'm not a fan of. And like often banks actually like particularly bad to businesses when it comes to these fees. So that's another reason to use us. So how about pilot versus bench?
Sure.
Same.
Sure. So someone wrote here, why should a startup or a business use pilot versus bench? And I think the answer is actually very similar to the one Immad gave, which is to say, in general, as I think about what service providers or software or tools to use, the question I have is, are they experts in my type of business? And so one of the nice things about Mercury, for example, is if you look at how they talk about themselves, if you look at their expertise, it's, well, we are a bank for startups. We know it super well. We have deep expertise in it. Similarly for pilot versus bench, and look, I think bench is a great product. The people are there very nice. They've got a niche that they serve very well. I think bench is really intended for kind of the really like ultra SMB, like the coffee shop or the bakery or the sort of, local business. Whereas Pilot's focus really is technology startups at various stages, ranging from literally one person who hasn't even incorporated yet, all the way to companies that have hundreds and hundreds of people and have a VP of finance and a controller and a CFO and kind of all this other stuff. And so I think, again, it's about leaning on providers that have deep expertise in the type of business you have. And so for us, for Pilot, it's the like short version of the bullet points here is we're very well versed in tech startups. We do accrual basis bookkeeping, and we do it all actually in QuickBooks Online. So you're not trapped in a proprietary platform we've built. You're on the industry standard. If you need to take your books to another provider, you can. So that's one of the things I sort of think about when people ask me about Pilot versus Bench, which they do a fair bit. And there's a sort of related question someone asked here. Does Pilot manage bookkeeping if some employees are remote? For example, if the legal entity is in the US, but some employees are based in Canada? Yes, that's totally fine. We have many companies that have that shape. We also have companies where there's a US entity and then a foreign subsidiary. Those are all, we will only do the bookkeeping for the United States entity, but it doesn't matter if the employees are remote or not. We can definitely handle that situation. And in fact, we do all the time. And again, this is like, well, why do we know how to do that well? It's because many of our customers have that shape. So we've seen it before because of our deep expertise in startups.
There's a question about benefit corporations. And it says, is there special funding considerations, challenges you've seen with benefits corporations? Benefits corporations, there's this kind of concept of public benefits corp. And from my understanding, and it's actually like in the startup world, it's relatively rare to see these. But from my understanding, it basically like allows you to like set up a company where you don't have to just care about shareholder value. You can care about some other kind of principle. Maybe it's like, doing the best thing for your customers, or maybe it's like a kind of like a climate change focused kind of principle. So it kind of ingrains this idea that like shareholder value isn't necessarily everything to the company. Generally speaking, what I've seen is that companies that get like a little more mature, so like a famous example of this is Kickstarter. I believe they're a benefit corporation. So when they get a little more mature and they're thinking, they've got past the am I going to die tomorrow stage, and they're thinking more about, okay, how do I want to see the future of this company? That's often where they set it up. I think when it comes to like funding or like, I don't know, budgeting and things like that, I don't think it matters too much. Like it's a normal corporation, and like most of the taxes and other things are fairly standardized between it and a C Corp. So yeah, I don't think investors will see it as like a negative thing or anything like that. But yeah, I'd like to see more of these companies happen. I think it's actually like a fairly positive thing.
All right. Well, I think that covers it, Immad. Thank you so much for joining us. For all of you who tuned into the webinar, thank you for joining us as well. Thank you for the time, and I hope you found this content useful.